Hey guys, what's up? It's me, Jonathan, and welcome back to Money Talks. Today I'm going to talk to you about how the credit card works, how you can use it to start to build your credit, and then how do you actually pick a credit card for you to use. If this is your first time joining me here on the channel, go ahead and hit that subscribe button and ring that notification bell, and you will be notified every time I upload a new video. So for many people, the credit card is the entryway into establishing credit and starting to build their score for their financial future. One of the things that usually comes up is immediately when you start researching credit cards is utilization. Well, utilization is if you have a $500 credit card balance limit that's given to you and you use about $150, you put $150 on that credit card and you carry that $150 to the next month because maybe you only made a little bit of a minimum payment, well, that means your utilization is 30% or lower. Now, if most of you have been following me for a while, my channel is more about helping you understand debt and get out of debt and use it more as a tool for you to grow forward. So I want you to understand that it's not necessary that you carry debt on your credit card for it to be impactful on your credit score. What you can do instead is you will actually use the card for something that you already have the money for. Meaning a cell phone bill, maybe you were just about to pay for gas, you can use your card instead for that, but something that you already had the money in your account for. The purpose of this is when you're beginning to learn about your credit and start to build your credit, you need to know that when you use a credit card, only use it for something you already have the money for. Second, if you do that every time and you pay for that credit card charge within 2 or 3 days, that will not only keep you under that utilization, but you will have a practice of paying on time. See, on your credit report, it doesn't show how much you paid on your last bill or how much was spent or anything like that. All it's going to show is that you had a payment due and you paid it on time in full. And because it's no balance, it will look very favorable because there's no debt out there for you. That helps the calculation rate go up. Second, how do they actually make money off credit cards? Well, that's a good question. The first way they make money is fees. Typically like an annual fee. So if you have a card, you're just getting charged just for having a card. And the annual fee is very popular when you're first starting to get a credit card because typically before you even receive the card in the mail, you've already gotten a fee charge. So there's debt already that you have to pay off. But there's another fee that creditors usually use, lenders usually use to charge you so that they can make money. It's called a balance transfer fee. A balance transfer fee happens when you open a card and they usually send you what's called convenience checks. And you can use these checks to go pay a personal loan, buy a new item, something of that nature, where when you use that check, it transfers the amount you paid either on the credit card or a previous debt to your current card. And in the process, it charges you a balance transfer fee, which for a bank is usually about 3 to 4%. Or for a credit union, it usually falls around in the 2 to 3% of what you bought. So if you bought $100 worth of stuff that you're transferring in a balance, it's about a $2 to $4 fee. This is very important for you to understand because number one, some banks or credit unions have promotions where that fee can be waived, or you can simply negotiate and have that fee refunded to you. So really understand what's being charged. The next way you're being charged with the credit card is with interest. Now, of course you knew this was going to happen because there's a loan involved, and a credit card is a type of loan. So interest is usually charged on a credit card when you slide your card and put money on the actual card and carry it over to the next month. So if you have $100 that you charged on the card and you only paid $25 for your bill, well, you have 30 days to actually pay the other $75. And if you don't, that $75 is subject to interest. See, with credit cards, it's a universal rule that if you have 30 days to pay this balance in full and no interest will be charged. The second form of interest that a credit card will charge you is through what's called a cash advance. A cash advance is when you use your credit card as if it was something like a debit card and you pull off cash. So you may have went to the ATM, or you may have been at a merchant or a store, something of that nature, where you've gotten cash back from this credit card. The trouble with cash advance is it charges you the highest interest rate that lender can charge you, and it charges it immediately. So if in our previous example, if you have a $500 credit card limit and you've already had $200 on that card, well, if you pulled $100 off of it, you have to, and you as cash, you have to pay off that $100 first before any money that you're paying towards the card will go to that other debt. And that $100 is being charged immediately at that highest interest rate. The reason why this can be a tough scenario is because if you were only able to pay a minimum payment or a little bit of money, it can make you be charged in interest a lot. And as your debt grows, it becomes tougher to pay off. It's really, really very important that you understand when you're dealing with credit cards, there are rules that you do not need to negotiate on. Number one, if you don't have the money in your account, don't use the card. Number two, always make sure you pay off within 30 days. And then number three, never pull cash off the credit card. These will be essential baseline rules that will follow you and help you as you start to develop your relationship with that lender. Now, how can a credit card really help you? Well, the thing about a credit card is it isn't what's called an open-ended loan, meaning there's no end date when you pay this debt off. So if you had a balance on the card or when you use the card, it doesn't automatically close every time you pay it off. Unlike a personal loan or an auto loan, when you pay those off, those loans go away. A credit card is still open and free for you to use. And thus, because it's revolving and open-ended, it reflects more positively on your credit report. The second way a credit card actually helps you is you can actually grow the limit on your credit card because that extended limit can help make up for what's the other big piece of your credit score, time of positive payments. So if you don't have much time with credit, it's going to be very difficult for you to grow your score. So by growing that credit card limit very rapidly, it can actually help make up for that time. The only thing about it is because you're so new to credit, you have to be very, very particular about when you're pulling your credit, not missing a payment, and managing those pieces very, very tightly, because when you do, your credit score will sink very quickly because it's still sensitive and it doesn't have that time as a foundation. See, credit and investments share one common thing, and that's time. You need time and credit so that you're giving credibility of good behavior over time. You need time investment so your money has opportunity to grow through compound interest. So now that you understand a little bit about how the credit card works, how do you pick a card? Well, first, understand that the number one thing is you don't want to get a store card. You want to get a credit card that you can use anywhere universally. So you can use it at stores, you can use it at travel, you can use it any kind of way. Do not get a store card. Those will not only mess up your credit score, but it will not help you make the long-term benefits that you're going for. Second, really start to look back and think, hey, have I gotten any pre-selected offers? If I have, let me look at those options. Are they charging me an annual fee? Do I get rewards? Things of that nature. But I want you to take a step further. Really call on those offers and ask them, what is the process for extending the limit? We know you need to build your score, so building that limit is going to be a key piece of that. Will you have to pull your credit every time? Will you have to just build your relationship? Everyone has different factors of how they build your score. The other question I want you to ask these lenders is, what happens if I get myself in debt? What type of programs do you have to help me get myself out? That can just be helpful, as though you don't want to get yourself in debt, but the fact is it does happen. So it's important to know what options are available. The other option of how you can pick a card is, yes, you can look at interest, but interest is not a big deal because you're not going to carry a balance over each month, right? Second, you can also look at credit unions. The reason why is a bank will actually look more for a straight line of criteria. A credit union has a little bit more personal feel where they're able to take a consideration of your total situation to help you start your credit journey and do it on more favorable terms. I hope this information is helpful for you as you start to look at how this credit card tool can be helpful for you to build your credit. And I can't wait to see you in the next video.